Hello everyone, this is Across University. Today, we are going to explain the trends in the Japanese yen. The US dollar continues to exert pressure on the Japanese yen, and there are several reasons for this. Firstly, the relative strength of the dollar is primarily due to the steady growth of the US economy and its higher interest rates. The Federal Reserve has adopted an aggressive rate hiking policy to combat inflation, making the dollar more attractive compared to other major currencies, especially the yen. In contrast, the Bank of Japan continues to implement ultra-loose monetary policies, maintaining extremely low interest rates to stimulate economic growth. This widening interest rate differential between the US and Japan attracts investors to higher-yielding US assets, driving the strength of the dollar against the yen. Moreover, increasing global economic uncertainty, especially with rising geopolitical tensions, boosts the demand for the dollar as a safe haven currency. Although Japan is also seen as a safe haven, investors prefer the dollar due to the more robust foundation of the US economy and higher market liquidity. Additionally, rising energy prices put more pressure on resource-importing countries like Japan. Japan needs to pay more foreign exchange to import oil and natural gas, further weakening the yen's purchasing power. On the other hand, the US benefits from higher energy prices as an energy producer, supporting the dollar's strength even more. The US dollar initially pulled back slightly against the Japanese yen, only to show signs of resurgence. We tested the 50-day EMA before pulling back a bit, but ultimately, this currency pair showed enough value to attract renewed interest from investors. The 155 yen level is a significant psychological support area where buyers have previously stepped in. Given this, the market is likely to target the 160 yen level, another critical psychological threshold. Overall, as the interest rate differential continues to favor the United States, I believe this market will continue to rally significantly in the long term. Recently, we saw the Bank of Japan intervene, but this is merely a temporary fix for a larger issue. They can only slow down the dollar's rise against the yen but cannot change the underlying fundamentals. The interest rate differential remains substantial because Japan cannot raise rates due to its massive debt load. The 155 yen level is massive support, so if we were to break down below that, it would be a significant event. However, I think we are currently stabilizing, and if we can break above the 158.4 yen level, it could open the floodgates for more buyers. Furthermore, Japan's current economic environment significantly influences the yen. Japan is currently facing weak consumer spending and inflationary pressures. According to recent data, Japan's Consumer Price Index, CPI, shows an increase in inflation, but overall consumer spending remains weak. This means that even though prices are rising, consumer spending has not seen a significant increase. This situation makes it more challenging for the Bank of Japan to choose its policy actions because raising interest rates might further suppress consumption, but not raising them would fail to effectively control inflation. These economic challenges in Japan further weaken the yen and highlight the pressure from the strong dollar. In this context, the dollar's relative advantage will continue to drive the appreciation of the US dollar to Japanese yen exchange rate. If you enjoyed this video, please like, subscribe, and hit the notification bell to get the latest updates.